And we are live. What's up, guys? Welcome to FreshandFit Podcast. We are here with Steve
from accounting.
Steve from accounting, aka
Money Mondays.
Girl, man. It's Money Monday. Let's get into it, baby. Hey, what's up, guys? Welcome back to the FreshandFit Podcast. It is Money Mondays. We are here with Steve from accounting, aka my accountant. We got a great episode planned for you guys today. We got the whiteboard out, so you guys already know time. You guys already know it's time to educate, baby. But real quick, before we get into the show, patreon.com/freshfit. Go ahead and get the behind-the-scenes content there, guys. We got the crazy girl that got arrested for punching our valet guy. Whoa. We got that on footage.
Whoa.
She knocked over the fucking thing. Yeah, I know. Chris, this dude's like, what the hell? I leave for a few months, and you guys are doing all this shit. You know what I'm saying? So that went wild. It was a good our valet guy actually filmed it for us. Shout out to him.
Yeah.
And we got that on Patreon.
I didn't see it.
You didn't see it?
No, I didn't see it yet.
Well, whose fault is that? My nigga?
And I'm busy.
You could have seen it yourself.
Yeah, man. I'm doing many things. So.
But nah, she was going crazy, man.
Yeah.
The video is hilarious. Guys, if you want to see in 1080p, well, 3K, 4K, whatever, the girl going crazy from the podcast, like, she was calm here. It was like calm before the storm.
Yeah. Well, the chick we kicked out like yesterday, last week, when she was like, "Oh yeah, you guys are racist," blah blah blah, and then she goes and perpetuates the stereotypes, and I'm just like, okay, all right. Yeah, seriously. But anyway,
we had an awesome Zoom call on Sunday, though.
Yes, we had a great Zoom call yesterday. We talked about real estate, making money, girls, everything else like that. Just a general discussion of the sexual marketplace. We talked about that Caleb guy, which we're going to cover that also, guys. Probably this Wednesday. We'll probably cover that this Wednesday for y'all.
He's pushing P for real.
Yeah, P. So check us out over there, guys, on patreon.com/freshfit.
That was true, though. It wasn't a joke, bro. Like, come on, man.
And then also, guys, check us out on Spotify, Google, and Apple Podcasts. Every single platform you listen to podcasts, we are there. Just make sure you wear headphones, especially nowadays, because we're public enemy number one. We are the villains, guys.
Apparently.
And then also get the merch, guys. FreshFitPodcastStore.com. Check us out over there. We got all the merch, the hoodies, t-shirts, sweaters, etc. Who hurt you? I feel like basically all the female slogans that we know that we've known to come and love. All right, so check us out over there.
Fresh Never Wears.
Yeah, that Fresh Never Wears.
Thanks, Chris. I was trying to avoid that.
I don't know what is that? Is that like a bandana sweater?
Hey, man,
Yeah,
I'm
man. Do rag.
I'm a grip gray instead of. Actually, never mind. I was trying something, bro. I was trying. Okay, that was horrible.
It is terrible how unfunny you are, bro. Holy crap. It is painful, man. All right. Fresh and Fit Clips, guys, our other YouTube channel. Check us out over there. If you don't got time to watch the full podcast, go ahead and check us out on Fresh and Fit Clips. We break it down from like 2 to 20-minute segments. And we also post clips on this channel as well. We only post 1 clip per day on here, but we post 2 clips on our Clips channel. So check us out over there. Fresh and Fit Clips. Also, Fresh has a vlog channel.
Guys, for behind the scenes, man, and tell you what I'm going to do already. I'm actually going to do live streams on my channel with girls and celebrity guests. So stay tuned for those episodes coming out. And yeah, I'll do vlogs on the other channel for the most part. So shout out to y'all. 100K on the way. Let's go.
Yeah. And then also, guys, Chris, you want to tell them about your stuff?
Shout out to the merch gang, by the way. Great stream this weekend. Follow me on Aaron Poxon on Twitch. We did some good streams. Also, too, I graded my gaming channel, acpgaming.com. So if I'm typing in the chat and you guys are confused, that's me, guys. Relax. I will release my first video this week. So tune in. Let's get it. And ladies, if you want to come on to our show, DM me and Aaron C. Poxon. Once again, this weekend, some of you ladies are DMing me with no pictures, private profile. Please unprivate your profile and make sure I can see you, because if I don't see you, then you won't be seen on the podcast.
There you go.
There you go.
Do I see a leopard behind you? Speaking of seeing, what the hell?
She's prowling in the corner.
Oh shit. All right. So cool. And then what else do we got here? And also, guys, I got a new YouTube channel. It's called Fed It. I broke down the goddamn, I'm running K-Flock case yesterday. Shout out to somebody in the chat. Yeah, when I broke down the case, I actually went over because he ran from the cops, right? And he tossed the gun, and we found the area where he tossed the gun, and we showed the route of how he ran, everything else like that. Somebody in the chat said his name is Elflock now, and I was fucking dead, bro. So the chat is undefeated. And then like where he shot the guy, the name of the place was the Final Barbershop. Dudes was like, yo, he got his final fade. I was
Damn,
like, what the fuck, man? Yo, you guys are fucking hilarious, man. But yo, real talk, I hope, yeah. But I really hope that he beats the case, guys. But you know, looking at all the evidence yesterday, as y'all saw on that show, we broke it down fucking micro. There's no one that has a more complete breakdown on that case than I do right now. I pulled out the court documents that's never been seen before, and it was a really good show. Everyone enjoyed it. Thank you guys so much. We had a bunch of live people watching. The engagement was through the roof. So thank you guys so much for that. Love you guys. And I'll keep bringing on the heat. The next case I'm going to break down is the Old Block case, okay? AKA Lil Durk's people, the RICO indictment that they got a month or two ago after the FBG duck killing. So stay tuned for that one. That'll be the next one I break down. But other than that, man, we got a special guest in the house. Steve from Accounting, man. Can you introduce yourself to the people?
Appreciate it. Thank you. Back again, and I'm in the thick of things right now with tax season. It's we're kicking it off. We're in the thick of it right now, and I don't know how the hell I got out of the office and I made it here from across the state. But yeah, it's a pleasure to be back, and I'm here to answer any questions and give knowledge to your audience, and yeah, I'm here to help.
I'm curious, how many clients have you gotten from the show, roughly, you think?
I get a lot of people hitting me up on the DMs there. I mean, I would say at least maybe like, I don't know, 30, 40 at least.
Damn.
Yeah.
And he never checks his Instagram. And he can only take on certain types of clients.
I need help. So anybody in the chat that's got any expertise at that, I could definitely use your help.
Can you tell the people a little bit about your background as far as like, I know you were involved in real estate for a bit.
Yeah.
You own multiple businesses with your accounting business, because he runs the business himself. He's an accountant, but he actually is the owner of his own company, and there's multiple locations, right?
Yeah. So we have we're on the west side of Florida. We're in Bradenton and Sarasota. We've got 2 locations, and we basically deal with high net worth individuals, private business owners, mostly S corporations, small business owners, that is. And we do full gamut of services for them, whether it's full service accounting, CFO level type of services, tax strategies, payroll. We have a payroll company that we handle payroll for a lot of clients. And then prior to that, I had a large radiology, like portable x-ray company in the state of Florida. So we had just basically cars that went around with x-ray machines and ultrasound machines. And we went to like nursing homes and different type of medical facilities. And we would go on site and take x-rays of patients or ultrasounds or EKGs, send those to like the teleradiologists to read and send the reports to the doctors that were ordering them. And then we sold that in 2012 to a multinational company. And then I went back into becoming, to being a CPA. And that's when I got kicked off my practices. I acquired a couple practices over the past couple of years. Mm-hmm. And prior to that, I was in real estate, kind of what you're doing now with the residential rental properties. Mm-hmm. But mostly I was flipping them because it was prior to 2008. And the market was like, basically you'd go out and you get a property for like, they'd be asking for like 200,000. Somebody come in and offer for like 220 or 225, above asking price, similar to what's happening now. But the banking system basically was giving anybody, with a
and
pulse
this is you,
money.
and you were doing this. You were, if I'm not mistaken, buying, fixing, and flipping. This was back in 2006, 7 before the housing crash, right?
Before the crash.
3 to like 7.
Okay.
I sold my last property in 7. I was hung on to one that we rented for a while. And then we managed to get rid of that one, luckily, right before everything crashed. That was just luck. It wasn't like I knew what was going to happen to the market. I just happened to sell that last property, and then I started,
right before the crash.
Yeah.
Wow.
Yeah. That was just blind, dumb luck.
Yeah.
But the thing was, the house that I lived in, I had bought right at the time, right at the peak, and then that went down. But we ended up staying in that house for years.
Okay. And it went back up and
right?
Because you lived in it, don't matter at that point.
Yeah. I had a friend that actually came down from New York. He bought a house right at the same time, and then he bailed out after a couple of years. And I'm like, listen, just stay in it. Like, 5, 6, 7 years, it's going to come back. Just, really. And he wanted to bailing it. And,
it always amazes me how people like start freaking out when anything dips, like with crypto, with real estate, whatever it may be. And it's like, I want you guys to know that like, you don't lose money until you actually sell. Exactly. You know what I'm saying?
Exactly. That's called unrealized.
Yeah.
There's realized and unrealized. You don't like capital gains tax basically is only on realize when you actually like sell it. And that's kind of like the crypto course with Charlie and I
Shout
think
out to
Miguel.
him.
They talk about.
I had a pretty long conversation with him. I was
Yeah.
telling him, dude, you need to get real estate, bro, immediately.
Yeah. So when it comes to real estate, you don't want to be a speculator. You don't want to be a trader, like
Mhm.
you're trading, buying short term and trying to flip it. It's a long term strategy, kind of like what you're doing right now with all your rental properties.
Yeah.
You don't have any, even if some of those have appreciated significantly.
Yeah.
But you're not looking to sell those right now. Even
No,
like on a
hell no.
couple properties that might have gone up $100,000 in just
Yeah.
a couple of months.
Yep.
Nice profit for you, but I think your long game is to hang on to that because over the course of 5-10 years, that's gonna basically.
And we're going to go over that in
be a lot
detail,
better for you.
guys. I'm actually really, really excited for this episode because we're going to give you guys a bunch of reasons how, and we're going to be mostly heavy on real estate, but we're going to talk about other assets as well, other asset classes. And then on top of that, we're going to have a Q&A at the end. So this is your chance, guys, to ask
Anything you want.
probably
yeah.
one of the best accountants in the state about this stuff, man. He owns his own practice. He's been
Legendary.
doing this for a while. He deals with, entrepreneurs, high net individuals. And yeah, I mean, Steve is the type of accountant where he's going to find a way. A lot of people say, oh, I don't think we could do this, whatever. He doesn't say no. He finds, let's try to find a way to say yes.
That's legal.
You know what I'm saying? That's legal, of course.
Absolutely. Yes.
That's legal. But
Absolutely.
you have to be, when you're an entrepreneur, just like you're aggressive with your business, you got to be aggressive as far as like, saving your money too. Because if you don't, or you don't know what you're doing, Uncle Sam will destroy you and take your money, bro. So this is why the rich stay rich. And we're going to show some of those tricks to you guys today. Which
And
I'm
also,
really excited
having
for.
real estate in portfolio is important for your growth, as for taxes and for wealth. So there we go.
Absolutely. Yeah. It's, I think, and I think you had a stat on that. I believe like
Like somewhere
highest-
around 90 to 95% of
millionaires.
millionaires
yes,
all own real estate.
Yeah. It's a huge asset portfolio holding for many of these
Yeah.
high net worth individuals. And that's the same thing I see in my practice is basically the ones who have accumulated the most wealth over the longest period of time are all in real estate.
Yeah.
All of them.
Yeah.
And, no college degree
Yep.
required. Not trying to offend anybody there if you're going for a degree in something that, you need a degree for, but, they tend to be the most wealthy people.
They're just smart. They bought low,
Yeah.
held it, and boom, just time did the work for them.
Yep.
You know what I'm saying? All right, so hit some of these chats real quick. We got Venom233. For the record, the first caller on the early Friday show was not me. I was confused AF watching the replay. Y'all saying Venom was on the line. Okay, no worries. Johnny, $50 super sticker. Thank you so
Thank you,
much. I
Johnny.
appreciate that, my friend. Are you guys on Rumble? $5 from Too Good Gaming. No,
we are on.
but we are on Cameo.
Cameo.
Then we got
Pornhub.
King Chris, $5. Fresh Fit, the most lit podcast, 22. We're going from 0 to 1 million fast. So watch the throne. Shout out to Fresh Fit fam and Steve. Yes, guys, we have hit the mainstream officially, bro. We got YouTube channels that are like 10 times bigger than us talking about us and stuff.
Yeah.
So it is what it is.
E3.
Okay, so that's a little bit about Steve's background, guys. What he used to do, and obviously, as you guys know, he's me and Fresh's accountant as well. He's helped us quite a bit, especially with saving
Taxes,
money and being able
Real
to
estate.
purchase things in a in a strategic fashion. For example, we bought the Range Rover last year. That was all a calculated plan, being very tightly coordinated with Steve as far as like turning that liability into an asset to help us save some money. So, and we can go over that as well today. But can you tell us a little bit about because the last time we were on, we were taking was Biden in office yet? I don't think so. Or he was just coming into office last time you were on here.
Yeah, and we were talking about the updates. No, actually, no, I was after.
Okay.
They were proposing that it was his first year of the administration. They were proposing that the changes. We didn't know whether they're going to be instituted retroactively last year.
Yes.
Which in most cases they don't. But then,
So let's
now.
talk about that. So we're going to break down some of these new tax laws, by the way, guys, that you should be aware of that people aren't really talking about. They're more concerned about this beer bug, but these are some other things that you guys probably want to know about as far as these new tax laws that came out under the Biden administration. So,
I think for your audience right now, because there's going to be a lot of like maybe single filers. I would imagine that would be your base with a young men. I think 3 of the major ones that I kind of identified right now that I think you guys are going to probably face.
get your notebooks, guys.
Yeah. Is going to be the economic impact payment.
Okay.
That was a stimulus payment that everybody got.
Okay.
I don't know if you get it. Did you get $1,400?
No, I didn't qualify.
Okay. Yeah, you were. Oh, yeah, that was last year. Yeah, what am I talking about? So anyway, so if you're below $75,000 and you filed in like 2019 and 2020, then you would qualify for the stimulus payment.
Mhm.
A lot of people got them like in January, February of last year. And I saw in my practice prior to that where they were doing the $600 and all the other the first stimulus and the second stimulus. Everybody forgot to. A lot of people didn't check their accounts because it was direct deposit and they didn't realize they had them in there. So we asked them. We made a point of asking them, did you get the payment? Did you get the stimulus payment? A lot of people forgot they got them. They put that they didn't. Then they thought that because you could apply for a recovery credit on there if you didn't get it. So let's say you were supposed to get the $1,400 and you got it.
Mm-hmm.
And then you go to file your taxes this year and you forgot that you got it and you tell your accountant, no, I didn't get it. Or you filed it, you didn't get it. And then it's going to give you a credit, a recovery credit of $1,400. So it's going to add that to your refund. And
which that's considered earned income, isn't it?
Well,
Is
no,
that
it's not.
taxable?
It's not that it's income. It's
Okay.
a lot of people were getting letters and they were saying that their refund was reduced or they maybe owed because they were calculating that they got it. It
Okay.
caused a lot of problems.
Okay.
So that's one that you guys want to be very careful. Check your bank accounts. If you qualified for it, if you have $75,000 or less as a single filer, check your bank statements going back to January or February of last year. You would have gotten $1,400, and if you got it, then you don't put it down on your return this year. And if you didn't get it, then you have a chance to get it, and you put it that you didn't get it, and you'll get it with your refund now.
Bam. There's
So
some
that's one that I know people are going to have. That's going to be a problem for people. And I think just the other one is I don't know if you got like people with dependents and you get the child tax credit. So that's gone up. But what they did last year is if you have kids and you filed for 2019 and 2020 with your dependents and they were below a certain age, then they started giving everybody automatic payments like starting in July of $300 or $200, depending on what type of dependent you had and what the age was. And that people started getting the payments in July direct deposited in their accounts. So now when you go to do your return, you can't, and if you got those payments for the 6 months last year, you can't double dip and you can't say that you didn't. You have to report that you got them. And then you have to consider that as the child tax credit, because if you didn't get them, then you could get them now. But if you got them, you have to factor that in there, and that's going to screw a lot of people up. You're going to see a lot of people.
And what's the name of that one? That's called
that's the Advanced Child Tax Credit.
Advanced Child Tax
Yeah,
Credit. Okay.
ACTC or something.
Okay. So listen up for you guys out there that might have children.
So that's going to be an issue too. That's one that is going to cause a lot of
Are
problems.
you breaking laws if you kind of like forget that you got it as well?
They'll know because
know.
there's a website too, and I'll probably have to post the link. I'll give it to you guys maybe later. You guys can put it in your chat or whatever. Where you can go there, and I think people had to go there and apply for it to start getting it, or maybe say that they didn't want it. So there's a specific site that you can go to, and then everybody's supposed to get a letter to say this is what you got to remind them to give it to their tax preparer. But that's going to be another issue. I think that a lot of people are going to wind up making mistakes on.
Okay. So these are things to look out for, guys, on your taxes for 2021 when you're doing them.
And then the other one, there's only three I think that would pertain to your audience is if anybody was unemployed and got unemployment compensation. I know in 2020, if you got anything below $10,200, you didn't have to report it as income.
Okay. Obviously because of the pandemic.
They got rid of that now. So
Okay.
2021, if you got any unemployment compensation, it's fully taxable.
Okay.
Wow.
All right.
Yeah.
So that's something to keep in
That's
mind.
one that they kind of like, yeah.
Oh God, man. Okay. All right. So for all you guys out there that were trying to get somebody, save somebody off the unemployment, I got to pay tax on that this year, not last year, but this year you do. Okay. And then was there anything else that you want to? So so a quick little
Those
recap
are
of that.
three, yeah.
3 things to worry about in 2021 as far as like filing your taxes and making sure you don't get a hiccup here is the first one was called
The first one was called the economic impact payment, or they call it the stimulus check. Hey, did you get your stimulus check?
Yeah.
That was $1,400 for last year in 2021 per person.
Yep.
Per person.
And then the second one.
And then the other one's going to be the advanced child tax credit.
Okay.
Where people started getting those in July of last year. They were gotten anywhere from $200 to $300 a month. and that was getting your child tax credit that you normally would get at the end of the year. You were getting it ahead of time, advance. Yeah. And then the last one would have been the unemployment compensation they did away with. So it's any unemployment you got in 2021, you have to include it.
Okay.
Unfortunately.
The 12 Dirty Dozen IRS. Did you want to talk about that too?
That's kind of like, yeah, we can get into that like a little bit later. I think that's, yeah,
that comes
kind of
in
segue
later.
into like some of the things that they're like kind of going after this year, and they're beefing up their audit staff, and there's a couple strategies in there. And we had talked about that, I think, in private on some of the, like, not that anybody did that strategy, but there is one particular one that was a pretty good strategy. And I think that we should talk about that one because it pertains to real estate.
Okay. So you want to transition over to the real estate now?
Yeah, well,
is there anything else?
I think the major thing that you wanted to talk about is, in particular to your situation, is on the rental properties for the cost segregation.
Yes, depreciation and cost segregation. Yeah. So, all right, so we'll switch over to real estate now. All right, so those were some things that you guys wanted to cover as far as, like, your 2021 tax returns. Any chance to catch up with Chris, or?
Yeah, we have some.
Okay, I'll read these real quick, and then we're gonna go into real estate. And guys, this is gonna be the secret sauce on
the best part.
This is gonna be how the wealthy stay wealthy, why guys like Grant Cardone, Robert Kiyosaki, Donald Trump, etc. This is why they don't pay taxes. What I'm about to show you guys, or actually, excuse me, what Steve's about to show you guys right now is deadly, okay? And it's all legal.
This one is good.
$20, edited regarding the advanced child tax credit. What if you had a child born this year but didn't get a tax credit for them? Can you claim that on taxes?
I'm sorry, I wasn't even. I was looking over that.
Yeah. Okay, so he goes and that's from edited DT.
Eddie DT.
And then I hate my job for crypto taxes. Are you going through every single transaction to calculate how much you owe? I hear some people are waiting for more regulation clarity before paying all their crypto taxes. Wondering about your thoughts, Chris. Could we save these questions for the end?
Yeah, that's a good one too.
Yeah,
I
these
do
are
have
really
an
good
idea
questions
on that one. Yeah.
So we're gonna keep going on with the presentation, guys, and then as you guys send the questions in, Chris is going to make a note of it, save it, and then we're going to answer all of them at the end. So, just be ready with the pen and papers and send your questions in now, but we're keeping a log of them. So that's 2 questions that we got right there.
So, okay. So on the question on the child being born in, if the child was
we can
born,
answer at the end, unless like it pertains to exactly what we're just.
Well, so if the child was born in 2021, you obviously probably would not have gotten that credit if you didn't go online and say that the child was born, because you didn't have the 2020 taxes, because they went off the 2020 taxes. So if the child was born in 2021, that wouldn't show on your 2020 taxes. So when they file this year for their 2021 taxes and that child was born in 2021, then they're going to claim that child and get the appropriate child tax credit, which if they're under 6, you get an extra $600. So it's $3,000 per kid that's 17 and under, and then it's an extra $600 if they're 6 years old and under.
Okay.
Wow.
So they should qualify for, pending their income level, they're up to $3,600 credit for that child.
Okay. And then you know what, real quick, we might as well answer that crypto question too as well. But send your questions in, guys, and we got y'all. What was that for the crypto question one more time? It was for crypto taxes. Are you going through, because we did talk about that child one, so that makes sense. Yeah. For crypto taxes, are you going through every single transaction to calculate how much you owe? I hear some people are waiting for more regulation clarity before paying for all their crypto taxes. Wondering about your thoughts.
So on the crypto, depending on what exchange you're using to onboard and your fiat to get on your fiat onto the exchange, and so all the transactions are recorded on a blockchain. It's basically like a spreadsheet on the internet. Yeah. That's all verified. So it's easy enough to get your transactions from your wallet on any wallet that you have, and figure out, on your trades and your swaps. But if you're not cashing out and you're just hanging on to it and it's going up in value, then there's really, it's unrealized. So there's no tax consequence to that. It's not until you cash out till maybe USDC or something like that, and you take it off the exchange, and then you have a reportable transaction there. That's a taxable event once you sell it. And like you cash out. So you buy Ethereum at 2,500 and it goes up to 5,000, and you cash it out to USDC and you take it out. Then that's a reportable. That's a realized gain on that currency.
So you don't get hit with the taxes, guys, until you actually pull it out, which is a gift and a curse with the crypto, because you can't really. I mean, are there any deductions right now as far as like the U.S. government goes with involving crypto? No, right?
I mean, maybe Charlie and Miguel.
I don't think there's any right now, bro. Like that's the one thing that sucks.
Like, what about art, NFTs, or like anything with that taxes? Or no?
I mean, that's non-fungible token. it's just like a form of, it's a token. That's like a cryptocurrency. So if it goes up in value and you sell it for a profit, it's just like selling anything else. It's like selling this, let's say this, this
Cell
phone
phone
or something like that. Yeah. And
Okay.
you sell it for a profit. Yeah. Same thing.
Okay. All right.
It's just digital. Yeah.
So real estate.
Fair enough. Yeah, that's why real estate's the best, man. Like, crypto is great for like appreciation and everything. It's really quick real gains, but it's like just as fast as you get those gains, Uncle Sam is just waiting with his fucking handout to take the gains from you with the the capital gains tax.
Yeah, a lot of people are just seeking out jurisdictions like hence Florida. That's why they're coming, because they at least can save on the state taxes.
Yeah,
not necessarily the federal, but they're looking at places like Puerto Rico and like Dubai,
Paul.
Yep.
Yeah. Because they're the tax benefits there are for capital gains are tremendous, and you don't have to give up your citizenship to go there.
Can we break down that Puerto Rico thing real quick before we get into the real estate?
Yeah.
What has everyone running to Puerto Rico? Can you break down the numbers for these guys? Why so many people are so? I mean, because it's crazy to I don't know if a lot of you guys been to Puerto Rico, but it's not the best place to be, man. It's fairly dangerous. You know what I'm saying? There's a lot of gun violence there. It is a beautiful island, but sometimes you forget you're actually in the United States. It doesn't feel like
and the prices are pretty up there as well.
And it's extremely expensive to live
aren't
there.
You Puerto Rican?
I am.
There you go.
So, but
I know a lot about it.
What has everyone going out there, man?
Well, there's very nice areas.
Okay.
There's very nice areas. There's gated areas. There's, I've never felt a sense of danger when I've been there ever.
Okay.
I don't know if it's because I was all this family or something or friends or, but I've never, obviously you kind of know where to go.
Mm-hmm.
But it kind of reminds me of Florida, maybe, but with mountains.
Okay.
You know what I mean?
Yeah.
And a little and more older buildings.
Okay.
So forth. But at any rate, a lot of people are seeking that because there's two tax act, the tax act 20.
Get your notebooks out, guys.
Tax Act 20 and Tax Act 22, and you can look them up, just Google them, and you can read, a little synopsis on it. But basically, people are migrating there because you can set up a business there. You have to have one Puerto Rican employee at least, but you have to stay there at least 183 days per year in order to qualify for residency there.
Is that like 6 months?
It's 6 months. Yeah.
Okay.
Yeah.
Okay.
So, and you could do it in combination because a lot of people like to travel back and forth. So if you keep good records on it, and as long as you stay there a month, come back a month, stay there a month, come back a month, or however, as long as the total amount in those 12 months add up to 183 days, then you're good. And then essentially the income tax rate there is only 4%. And then the other thing too, which is major, is that you don't have to file a federal IRS income tax return, even though you're not giving up your citizenship because your residency is there. You just file a Puerto Rican government tax return. You pay your percentage to the Puerto Rican government, and that's it. And they'll check on there's certain checks and balances that the government there has and make sure that it's legitimate. But it's a lot of people, especially these crypto guys that go there. But not every it's not for everybody. It's got to be you have to be if you're going to uproot your life and go somewhere, you have to check it out and be comfortable to say, can I last 6 months in this, this place?
I ain't gonna hold you. Like, to uproot everything to leave the States just to go there for taxes.
Yeah,
man, I don't know if I would really do it.
I mean, if you're making hundreds of millions, you
let's
can live very well.
So let's say
save a lot of money. I'm sorry.
So just so that people kind of understand the benefits. Let's say a scenario where someone is living in Puerto Rico versus, let's say, maybe a Florida or even a New York State. So they make $1 million a year. What could we kind of go through the scenario of like what they would be taxed while living in Florida versus being in Puerto Rico? I don't know if we could do that scenario.
Well, basically, just off the cup, just 40%.
Okay,
$400,000 versus 4%. 40, yeah. So huge major savings. So that's a substantial amount of wealth just in $1 million case. Enough to you can live very well there. The cost of living is probably cheaper than most of these areas that these guys are coming from. Yeah, it could be California, New York, Connecticut, wherever. A
lot of people from LA going there.
Right. So now you get and then you're also not having to file an IRS income tax return. You're not required to. So that's major in itself.
So how are you paying your taxes then if you're not filing?
You have to file a Puerto Rican.
Yeah.
Oh, which has
they have their own Department of Taxation separate from the IRS,
which is better than
it's a Commonwealth. It's not a state.
Yes,
because they have what is it, taxation and no representation.
There you go. So we're talking about 40% stateside versus 4% in Puerto Rico. So on $1 million income, you're going to be liable for my math sucks. Help me out here. 40% of $1 million is 400,000 versus 40,000.
Right.
Versus 40,000.
Exactly.
That's incredible.
But
Yeah,
okay,
so $360,000 savings just on that alone.
How about this, though?
That's
now you guys can see.
and a lot of people, they'll have second
multiply
homes here. It's not like they're giving up their entire life. They'll have a place here too, and so they come back and forth. They'll spend, because it gets hot there in the summer. It's kind of like what people do here in Florida.
right?
Maybe they have a place down here and they go back up to New York in the summer because it's so you can kind of do something like that.
But can I buy enough real estate here to like counteract the taxes so that I don't have to move per se? Like, okay.
I mean, it's possible, but the problem is like you can't consistently report a loss on your tax return year over year, because after a certain amount of time, after within the 5-year time frame, if that's not profitable, then the IRS could come back and take a hard look at it and say, okay, what's going on here?
And then that's when they take your money.
Shout out to Puerto Rico.
Yeah. So wow, that's huge right there. So we're talking about 40% versus 4%, and you guys obviously, the more money you make, you can see how that can compound over time.
Right.
On $1 million salary alone, you're liable for 400,000 stateside versus only being liable for approximately $40,000 living in Puerto Rico. Right. Which now I can see why people like Logan Paul and a bunch of other entrepreneurs are moving out there that are higher net worth individuals.
Well,
that makes sense.
They're thinking about going to Puerto Rico.
Well, he's already there.
Oh, he is. Okay.
Logan Paul, do you want
I
a
didn't know
neighbor?
that. Because there's some really nice areas. I mean, I spent a lot of time going around with a doctor client of mine, good friend of mine, and he showed me areas that I did not know existed. I said, if you go there as a tourist, or you go there like not in the know, there's a really lot. You have to go with someone that really knows the area.
Yeah, I went there, to San Juan. That was pretty much it.
Because that's just a tourist area.
Spots. I was like, all right, this is cool and all.
Yeah.
I'm from the islands. It's kind of boring. But those areas that you just spoke about, hey, that might be lit.
Yeah. Okay.
And it's not for everybody. Even some people just don't, like the culture. Maybe you don't like the food, or maybe there's a certain type of lifestyle. Like Miami's a lot different. You've got everything happening over here.
I mean, there's some baddies over there, but not like a lot though. From what I seen, I don't know. I could be wrong.
Okay.
Yeah, I don't. Well, you're in Miami, so it's all.
Yeah, definitely our perception of the studio. We got a lot of hot girls here.
Yeah.
All right, I'll read these real quick. Is unemployment the same as medical leave? $2 from the Miles. And then if I have a for-profit company, can I use sections 179 of the IRS tax code to get a G-Wagon? That's $20. We'll talk about that because we'll talk about that with the cars. And then Godspeeder, no question, just for the collection plate. Thank you so much, bro. I appreciate that greatly. All right, so let's get into transition finally over to real estate. So we got a board here, guys, where we're going to break down depreciation and then something else called cost segregation, aka accelerated depreciation, if I'm not mistaken.
Yeah.
And they're two different things, and we're going to show you the power of having real estate and how it can significantly reduce your liability. And when you guys do the numbers and see, just like we did with Puerto Rico, you can see how this can quickly add up and save you tens of thousands, if not millions of dollars, depending on how much money you earn per year. So before we show them an example on the board, Steve, can you explain what depreciation is first and then what cost segregation is? Which, think of it, if I'm going to put it in a way, think of like, for all my DBZ fans out there, depreciation is like Super Saiyan 1 Goku, okay? And then cost segregation is like fucking God mode Super Saiyan Blue Goku, okay? So that's what, basically, if I can put it in a weird anime nerdy version, that's what it is. So can you give them Steve's like, what the fuck are you talking about, bro? He's like, what?
So depreciation. All right. Depreciation basically is if you buy an asset for a business purpose. Okay. It's an asset for a business
home
purpose.
or a car.
Home, car, piece of equipment, real estate, obviously. And everything the IRS assigns a useful life to, meaning that, let's say it's a car, right? So a car has a useful life under the IRS rules of 5 years. Now, that person in there in the chat talked about a G-Wagon and what you guys bought your car last year. There's certain cars that are heavy, and they're over 6,000 pounds, where you can write the whole thing off in 1 year. But typically, if you don't take those accelerated methods, those preferable methods for tax purposes, then you would write it. You would go to the book and say, okay, this is a washer and dryer. It's 7 years, so you depreciate it over 7 years. So basically, depreciation is basically it's a paper expense on your tax return for a portion of that year. So you're writing off, you're depreciating it, and then you get down to what's called cost basis. So if you spend $100 on something and you divide it over 5 years, you're going to depreciate that thing $20 every year, $20 every year on your tax return. That's pretty much it.
Yeah. So it's the U.S. government's way of looking at it like you bought something that naturally is going to have wear and tear over time.
Right.
So now you're going to get a tax benefit because it's getting wear and tear. You know what I'm saying? But the benefit is that you're able to write that cost off on your taxes so that you're not liable as much.
And what it is the IRS's way, like in accounting terms, it's our way of an accounting of proper matching revenue, which is let's get rental income to how long that asset's going to last before you have to replace it.
Bam. Okay.
Okay. And then the IRS says, okay, well, we're not going to let you write everything off on all your assets. We're going to select certain assets that you can do that to have, like for instance, that we're going to talk about here with the cost segregation is pretty powerful. And you'll see in the illustration, like how much that really saves you in taxes. It's tremendous. Basically the IRS says, okay, we'll allow you to take a portion of that every year.
All right.
Yeah.
So cool. So I guess let's give them an example then. So we got depreciation.
I just did a simple one.
Accelerated depreciation, guys. So we're gonna give you an example of a purchase of a home and what the purchase of this home would help you with as far as taxes. And obviously you can apply this to other assets as well. Maybe we can even do an example with a car if we got time. But we're gonna do one with a house. Are we good on mic? Yeah. Okay.
Is this the mic down here?
Yeah. No, it's that one right there.
This one right here.
That one right
okay.
there. Yep.
Right, I'm gonna take these off.
So yeah, go ahead.
Can you guys hear me okay?
Yeah, just talk right into it. That one you got to be real close to it. All right. So shout out to Steve from See Beyond the Numbers. He's about to show y'all some numbers.
Steve from accounting.
Yeah, Steve from accounting.
So
the
first one I'm going to go through is like normally what most CPAs do or accountants or people that have rental property. What they do typically is they will just take like I used a $220,000 property. Okay. And I think Myron, you had a property very similar to this one.
Yes.
Similar,
exactly. At 260. So this is very similar. Yep.
So what you do is you have to break that property up, okay, into its component pieces. So we always allocate a piece of it to land. So let's say in this case, we're going to take 10% of it and we're going to put that as land. Okay. And then now you have $200,000 left over.
Yep.
Okay. That you have to depreciate, right? Let me put a little line here.
So the land is automatically cut out from the real estate, the property itself.
And then they just do building. Okay. Oops. So they just do building, right?
Yeah.
This here, land you don't depreciate.
Yeah.
So there's zero depreciation on it.
And I think that's something important that the audience needs to know, because some of you guys talk to me, like I've seen you guys ask questions about, hey, but what about buying land, etc. The positive is, yes, you can sell it and potentially get a good upside if it's in a hot area. But the negative is you don't get the same tax benefits for it, guys, because you can't write off land on depreciation, which I think is very important for guys to know.
Now, the building here, most people just do 27 and a half years. Okay. So that means the total depreciation on this configuration here is only, I think we calculate here, $7,272. That's depreciation. That's what you would get typically. This is probably like 75 to 80% of accountants or tax preparers will do it this way.
Okay.
Now, if you do a cost segregation, you don't have to spend hundreds of thousands of dollars. Like some people buy commercial properties and it's multi-million-dollar properties. They'll spend thousands of dollars on an engineer to come out and do a cost segregation study. Okay. In your case, you could just.
So this is basic depreciation right now, right? This is an example of basic depreciation.
This is the basic one.
So let's go over the numbers real fast so that people kind of know and they know what's going on. So this is basic depreciation first, guys. So you bought purchase price is $220,000, okay? And for this example, all right? And then 20,000 of that is considered land. So that is that what 20% or
10%.
10%. Okay. So 10% is automatically deducted, guys, off of land. So now that leaves you with the building price of 200,000. And what you're going to do is you're going to depreciate that over 27.5 years. And what that does is that leads you to what $7,272. And that is basically put against your earned income to bring your liability down, correct?
So you take that as a depreciation.
Yep.
Depreciation. Now you have rental income. You have your mortgage interest, potentially your real estate taxes.
Yeah.
Repairs and maintenance. And then you have depreciation.
Okay.
So that's just another expense line item.
Okay.
Yeah.
So the taxes, everything else, those are also write-offs as well? or no?
Absolutely. Yeah. Property
Can we
taxes.
give them maybe an example of like maybe what a taxes would cost on a property like this for a year, et cetera, so we can give them like a total?
Let's say it's in a nicer area, 5,000.
Okay. So we got 5,000, then we got 7,200, and then what else would hypothetically?
Maybe mortgage interest.
Mortgage
Maybe you
interest.
got a mortgage interest of 150 or something like that. And
Okay.
at,
Times 12?
3%.
Okay.
Or something like that.
So,
let's say it's I don't know, 7,000.
7,000.
Yeah.
Okay. So 7,000 plus 7,200, that's 14,200, and then another 5,000, that's 19,200. So would that 19,200 pretty much be taken now and put against their
Rental
income?
Yeah.
Yeah. Now,
Yeah.
if you so basically, guys, if you generate, let's say you make $20,000, right, that year on your rental income, you only you're only liable now for $1,000 of that income versus being liable on the 20,000 that you made.
Correct.
Because these things added up and basically brought your liability down. You guys see the power of that?
Yeah, so don't get caught up on the 7,000 alone.
Yeah.
Get caught up on everything else. That
Yeah.
adds to the total.
Yeah. Can we put like the taxes in there, 5,000 and everything?
Well, I just want to.
Oh, okay.
Okay.
I want to make the point because those are going to be the constants. This is the
Okay.
variable.
I see what you're saying.
This
Okay.
is the variable.
Okay. I see what you're
Tax is going
saying.
to be real estate taxes on both columns, right?
Okay.
But this is
Perfect.
this is the game changer here.
Okay.
So I think we focus on this. So if you do a cost segregation study, right?
Okay. So now we're going to do the more
Okay.
the cost segregation part of this, guys, which is another more accelerated version of depreciation here.
Oh, let's do this here. Excuse me. Same thing, same price, right? Same land, cost allegation, 20 grand for the land. Okay. But then instead of taking just the 200,000 and lumping it in 27.5 year property, we're going to take and segregate that into 50,000. Show you 50,000. This is a very simple like let's say my cost segregation study that I came up with came out to this.
Okay.
I went and said, okay, I allocated like 50,000. It's not necessarily always going to be this way, but I'm just going to drive the point home. Okay. So that's 200,000. So here, let's say it's like appliances or something.
Mhm.
Obviously that's high. Or let's say roof. Let's say roof.
Yeah. It's
Let's say
basically
roof.
anything that is non-structural, guys,
Okay.
is the big
Roof.
takeaway here.
Okay.
Let's
say this
paint,
is let's say this is electrical,
Mhm.
okay, which will be all the electrical components of the house. Okay. And then
Floors,
let's
maybe?
say- yeah, let's say this is let's see, what did I have on these here?
AC windows.
Let's say let's say windows, something like that. Okay.
Windows are expensive, man. Damn.
And now this I'm just gonna call it improvements, okay?
Especially hurricane impact windows.
Okay.
So now let's say we did here 15 for the roof. Okay. Let's say we did 10, 5, and then here 0. And then we'll get to that one. Okay. Because we could take bonus on here. Okay. So if we use these numbers here, now we've got depreciation of
Here, can you just talk to Mike, Steve, so they can hear you?
sorry about that. Yep. So we got depreciation of for the roof at 15. I think I did this wrong here. You gotta help me out with my eyes here.
Okay. So we got the first
50.
wait, hold on, 50,000.
Yeah, I got it here. All right. So let's say I think 15. 50 at 15, right?
What's your total?
Yeah. So we got 3 for there. What was the other one?
We're just lining up the numbers for you guys real quick so you can see kind of like how this this works.
And this will be 10.
Give you examples of like, but essentially what it is it's
65, sorry.
it's essentially non-structural fixes to the house,
This will be
guys.
10. Okay.
Back to
And
high
this will
school.
be 0 because we're going to take this as bonus. Okay. So in this case, we got 65, 68, 333
And then
in
the bonus.
depreciation expense. Versus if we didn't do the cost, only 7,000.
Okay.
So it's about a $61,000.
Okay, so let's walk them through that
difference.
so that they completely understand.
Recap. Yeah.
Yeah, let's recap that real fast. So now, we showed you guys how basic depreciation works. Now we're going to talk about how the cost segregation version, which, like I told y'all before, is the Super Saiyan Blue version of depreciation, how that works so that you can more aggressively, deduct and cut your liability down. So can you walk them through the numbers real quick with the cost seg on there, Steve, please?
Okay, so basically I took this roof at 15 years. Electrical, let's say components was 50,000 at 10 years. Let's say windows and so forth are 5-year assets, and that's $50,000. And then improvements, we can write them off because it's bonus. It falls under the bonus depreciation, meaning kind of like your car section 179. You can deduct it all in 1 year.
In 1 year, you can
Okay.
get it up front essentially,
So
right?
this one will say it's all 1 year. Bonus.
Okay.
This is the bonus, right?
Cool.
Let me put bonus in there so everybody knows. I don't want to put.
So you guys see the difference here, where now he's depreciating it over a shorter period of time versus 27.5 years. Now he can depreciate it over 10, 15, and he was giving you he's using different types of fixes so that you guys can see the numbers with 15-year depreciation versus 10-year versus 5-year, etc. So you guys have different examples and a bonus one as well. So
Correct.
it's multivariate there.
So I just did the math here, I lined them here, and total up my total depreciation deduction under my cost segregation, and you can see 68,000 plus versus just over 7,000. It's a $61,000 difference.
Yeah.
And then you could take that, and it's
huge.
Yeah. Now,
good.
So let's say this produced a loss.
Okay.
Now, and you're not a let's say you're not a real estate professional.
And we're going to break that down for you guys too.
Yeah.
Being a real estate professional, being not one, how this will help you. Sorry, go ahead.
So if you're not a real estate professional, you could take up a $25,000 loss.
Okay.
But if you are, then you could take the full loss. So in this case, let's say you're at a 25% tax bracket, just for simple math.
Mhm.
The difference in that is going to be tax savings of $15,250. That's huge.
And someone that's in a 25% tax bracket, roughly how much are they earning per year?
25% would be like, I think I want to say like in 150,000.
Okay, so that's substantial
Yeah.
for someone that is earning about 150,000 per year. So that cuts if you earn 150K per year, guys, gross, now they can only tax you on 135,000 gross, roughly.
Yeah.
Versus that full 150. So now you're not not liable for as much, right? So and then we got so all the numbers together, right? So we got the basic. So for this scenario here, guys, on a home that's $220,000, right? You got, and we'll walk you through it one more time because I want y'all to really understand this, because even though I'm terrible at math, maybe you guys will get it when I go through it. So the house, right? The basic. So you got two things. You're burning the candle at two ends here. You got $220,000 on the purchase price. Immediately, 10% goes out the window, right? Because the home is on land, obviously. Then now you only are left with the building, which gives you $200,000. You depreciate off that 27.5 years. That leaves you with $7,272 that you can now use against your income to kind of offset it, right? Then you take that same scenario and you can almost like double dip and do cost segregation, which is a more aggressive form where you're depreciating the things in the home that are non-structural, such as a roof, electrical, windows, etc. And you guys can see the power of it. That now has brought his liability down by approximately $68,000. So you combine that $68,000 with the $7,000, and then the taxes, which we figured out would be like what, $5,000, right? So I think we worked it out to like $19K or something like that on the basic depreciation.
Yeah. So basically, you would add this to your total. Let's say all the other.
You can take that mic if you need to.
Let's say all the other expenses were like 20 grand.
Yeah.
Right? So
20 grand.
This would be $27,000 deduction off your rental income. And if you had $50,000 rental income, then you got a profit.
Yeah.
Right. This one would be adding $20,000 to that. And if you had $50,000 income, it's going to produce a loss.
Okay.
On that one, because those expenses are going to stay the same whether you do cost segregation or not.
Mhm.
So you just add up your regular expenses for all the other stuff. So if your regular expenses, like for real estate taxes, for insurance, for repairs and maintenance, for property taxes, I think I said, in mortgage interest.
Yes, mortgage. Yep.
Let's say those all add up to 20 grand.
Mhm.
We add that with the depreciation expense. That's 27,272.
Yep.
Right. But if we had 20 here, that's 88.
Bam.
Still the same rental income. One produces still a profit. and you're paying tax. The other one, you're at a loss.
So just so people understand, is it better to be at a loss or profit for taxes?
Well, for tax, I mean, obviously, it's better to be at a loss. But for business purposes,
Mm.
you don't want to be losing money. You want to be making money. So, I
Right.
mean, yeah. But if you could take advantage of the tax laws and, pay less in taxes, that's the name of the game.
And this is what a lot of real estate investors do. And this is breaking it down category by category over a period of years, so you can get the best amount for depreciation, basically. So that's pretty good.
So
I mean,
Go ahead.
you could see basically now just you buy let's say you buy a building for $2 million.
yeah.
You can see how that is
Yeah.
pretty impactful.
How that would
Or
be
let's say
crazy.
you have in your case, you got 5-6 properties
Yeah.
you're doing this on. And then you can declare yourself a real estate professional.
Bam. And can we talk about how someone would go about? So guys, just on that scenario, basically he just showed you guys how he wrote off $88,000 off of his tax returns. So now he's not liable. He was able to basically bring his liability down $80,000, which is huge.
Yeah.
And that carries
Not-
over
it's
to
not-
next year, right?
It's not the liability. It's
Sorry.
the liability. Yeah, because you at 25% in this scenario, at 25%, the difference between those two expense line items, if you're a 25% effective tax rate taxpayer, in this case would be $15,000 tax savings.
There you
That's
go.
your
Okay.
liability
That's-
saving,
yeah, there you
which
go.
is huge. That's huge.
For
Just
someone at
one property.
150,000, yeah. Now,
Now,
this is someone that's not a real estate professional.
right now, multiply that by 4 properties. Okay,
Crazy.
so that's 60 grand. Yeah.
And guys, you don't have to do this math yourself. Obviously, go to a certified accountant that can help you with this process.
Yeah.
But just so you guys can see the background of why he does what he does.
Yeah.
Don't
Yeah.
get too caught up on the numbers that I use
Yeah.
up here because this is just very simple, man. I'm just trying to drive the idea home. Obviously,
Yeah.
this scenario
What the
wouldn't
potential
be.
is.
Yeah, this is not going to be exact numbers.
Okay.
Yeah, but it's
And
gonna.
then
It'll be the formula is similar to this. Yeah.
okay. And then I guess so the real estate professional, sorry.
So to be qualified as a real estate professional, you have to have at least 500 hours or more in a particular year devoted to that activity. So it's called materially participating. So that's kind of the benchmark there.
What are the benefits versus just being a regular?
Well, because in this case, let's say you have in that one scenario, let's say one produces a $50,000 loss. Well, if you're not a real estate professional, you're going to only take up to $25,000 of it.
Okay.
So yeah.
Versus being able to take the whole thing. So how would someone go about making themselves a real estate professional so that they can enjoy the full benefits?
They just got to substantiate that they have $500 or 500 hours or more in one calendar year.
Okay. And how would they be able to
Devoted.
prove it? Would be by amount of homes they own,
a lot
doors?
of
Would it
yeah,
be-
I mean, in your case, you got 6 properties, and you're managing multiple properties, and you're calling repairs and maintenance and collecting rents and seeking out other investment properties too throughout the year and devoting hours to that as well.
Yeah.
It's pretty easy to add up 500 hours if you have 4 or 5 properties.
Yeah, if you have multiple
Yeah.
properties, you can easily rationalize.
Usually
hey, I'm gonna-
IRC is like, because it's a Schedule E, and then you've got columns for each property. So if you see, 3, 4, 5 properties, it's pretty easy to substantiate that.
Let's say
real-
someone
yeah.
can only save up to buy maybe one property in a year. How would they go about?
I
making
would
this
say, if they go about like maybe getting their real estate license.
Okay.
Okay.
no,
that's one
a
way.
big one, because then you could substantiate that you're trying to at least work in that field. So
Mhm.
that would be another way to do it.
Okay. Maybe anything to do with like rehabbing a house or, maybe documenting when you go out. And I know a lot of people do like, what is it? Drive for dollars or something like that. Or people that basically go around and like look for homes that are like distressed or have owners that pretty much want to sell.
like
whatever.
rehabs.
Yeah.
Okay.
It's spending time doing that. I guess maybe they'd be
Yeah.
able to document that. Does the IRS check that heavily if you try to?
It depends,
Okay.
because if you have a really substantial loss to offset, then they might look at it a little bit more closely. Yeah.
Okay.
So you got to kind of like be a little bit realistic about it.
Okay. And because I think, the importance here is to show that like if you're a real estate professional and now you can, I think the biggest thing, and correct me if I'm wrong, Steve, here is when you're a real estate professional, let's say you own a business and you're a real estate investor, you're able to take that money that you make from your business and the money that you make from real estate that you're depreciating can also be used to offset your business earned income versus just your real estate
Right.
income.
That's when it become an issue, is when you have 2 competing types of lines of business, so they say, okay, one has to be, which one really is the materially participating. So that's really where you have to like document your activity
okay.
and your hours into that. And then there's ways to do that.
Okay.
There's certain checklists that we, go through and we substantiate that. One thing I like most real estate professionals to have is their real estate license. Are we at least working towards it?
Okay.
Yeah.
That's an easy
which
one.
it's pretty easy to get. I mean, it's not
Every
it's a little
bimbo that comes on the show is a real estate real
exactly.
estate agent, brother.
Especially-
That's like part time or some
They
shit.
feel like 4 times ready, but then they finally got it.
Yeah, they finally got
Yeah.
it. That right there will make you a professional. And I think, guys, it's worth pursuing because in my case, I'll give you guys an example. I own 7 properties, right? So I was able to kind of use the fact that I have these 7 properties to justify, hey, I am considered a real estate professional, which is worth it because when you're considered a real estate professional, now the income, you can basically use it to offset even your business income from your other job.
Right.
So that's very critical, guys, because if you can only do, what was it before, 25%, then
25,000.
25,000.
Yeah,
Okay.
right.
So
Right.
then
So,
that's not
right.
enough. You know what I'm saying?
Right.
Especially if you're making, over 200,000,
Right.
whatever it may be, you're only going to be able to write off 25,000. That's not that much.
So long story short, getting the real estate, having that in your portfolio, depreciating it, versus regular versus accelerated, can give you benefits of tax, paying less in taxes, and as well for your business.
Yeah. And I would say, just a quick side note, for commercial, it's, if I'm not mistaken, it's 39 years versus over a 27 and a half year schedule.
Yes. Correct.
Okay.
Yeah.
And and real quick with the commercial, is it can you be a little bit more aggressive? I'm assuming since it's commercial,
Yeah, because they're
it's
more
bigger.
Yeah,
Be more
there's
aggressive on like something with cost segregation.
they really break, like, that's really like, most commercial properties are going to be a lot more than like a typical residential, I think, in most cases. And then that's where it would benefit you to get an engineering firm that specializes in cost segregation studies to come out and do one,
Okay.
because they will take the nuts and bolts and everything.
They come out with a tape measure and
I
they
mean,
actually
they get so because you're spending a couple $1,000s, it's well worth it because the tax savings in this. Let's say you spent $3,000 on a cost segregation study. I mean, you're saving 15 grand in this scenario. That would definitely be worth it.
Yeah. So you can only imagine
And
doing
if you
it
got
on a commercial
multiple,
property
right,
worth a couple million. Now we're talking, you spent $5,000 to bring, some guy out with a protractor figuring out which you're gonna, could write off, but that could potentially save you hundreds of thousands.
Right. And
and I'm sure they give you documentation you can use to give to the IRS.
Everything. It's
So
it's bulletproof.
IRS try to say, hey, we want to audit. Oh, okay.
Yeah.
You actually
You triggered my trap card.
I got the fucking,
I'll tell you a quick story. I worked with early on, I worked with a partner, a CPA. He was a partner in a firm. His wife was a PhD, actually got a job with the Internal Revenue Service. And her job specifically was to do an analysis on depreciation. So that's why this cost segregation stuff is, and they paid her $200,000 a year. And all she did was basically study depreciation methods, and on all, like it was like she worked there for a few years. Huge amount of money that they invested. This would have been back in 2013 or something like that.
And as a former government employee, guys, no one really earns $200,000 per year unless like you're in Congress and stuff.
Yeah.
You know what I'm saying? That's extremely high for a government employee.
They shipped her out to Washington, D.C., and she spent like literally like working on this stuff. So the people that work in this cost segregation industry, they adhere to, like, they came out with all of this, basically all the rules of all the depreciation and all the component pieces, everything's on so those cost segregation study firms, they adhere strictly to those regulations. The regulations of the IRS there.
Damn.
Yeah.
Okay. Bulletproof, man. Bulletproof. So you guys could see, obviously, when you're buying like bigger properties or whatever, it's worth it to hire someone. On my scenario, we were able to just do it, regularly.
Yeah, you
basic.
did. Yours, it's a mini cost segregation study. You don't need to hire somebody to do it. You just kind of do it on,
Yeah. So we did it very, like, as you guys know, I talked about this before. I bought a property. I actually closed on a property, $265,000, right? I bought it cash because I needed to get it done before the tax year ended, and I didn't have time to get a loan. So bought it cash, $265,000. And the reason why I did it was because it was recently rehabbed. It was a turnkey property, and turnkey, guys, means it's basically ready to go once you purchase it. So I bought it. As soon as I bought it, I called Steve. Hey guys, hey Steve, I purchased it. This is, the address, etc. This is how much it's worth. And what Steve was able to do is he was able to use, the depreciation, which he just showed you right there with the example at the 27.5 year scale. And then we're also able to do the cost segregation as well, And that was able to knock off a bit more as far as like, what I would be, I guess, liable for.
Right.
So that's the importance of it, guys. Why it's like, it's so deadly, not deadly, but it's so important when it comes to, helping you out with your taxes. Then we also made myself a real estate professional. So I was able to deduct the full amount over $25,000. And all I'm going to say is I would have had probably double the tax bill had I not purchased those real estate properties this year.
Right. And in your case, on those properties, a lot of those were like improved.
Yeah.
So a lot of those improvements to those properties have better depreciation amounts to take. That's the key there on those.
Yeah.
So I think we talked about that.
Thank you for mentioning that. Yeah.
That was a big one because I think you went back to the previous guys and they could really, they had all of it documented.
So this is what I did, guys. All right. I'm going to give you all a little bit of secret sauce here. I purchased the houses, right? Basically turnkey, and they were all recently rehabbed. So what I did was I contacted every seller I purchased the home from, and I asked them, listen, roughly how much did you spend on fixing the home? And they have no point to lie to me at this point because it's like I already own the house. It is what it is. And they gave me rough estimates. We basically rounded down,
right? And
we were able to use those rehab costs of what they spent their money on to go ahead and offset my taxes. Okay, does that make sense? And then on top of that, remember, guys, when you purchase the home, let's say you get a loan and you only put $100,000 into the home is worth, $400,000. So you only put 25% down. Guess what? You could depreciate at the $400,000 price point, not what you necessarily put into it. You guys understand that? I'm going to say that one more time for y'all because that's really powerful. You buy the house for $400,000. You only put $100,000 of your own money into the deal. However, you could depreciate the entire cost amount of $400,000 from which you only put 25% of your own money and the other 75% came from the bank. So in other words, you're using other people's money to offset your own taxes so that you pay less. And this stuff like this, guys, is why the rich and the wealthy stay rich and fucking wealthy. This is the glitch in the matrix, guys, because the U.S. government, what I've come to realize is if you own real estate or you own a business and you're providing housing and employment to people, the U.S. government rewards that heavily and incentivizes them to give you big tax breaks because people that provide housing and jobs keep the economy going. So that's why you get such a big tax break on these types of things. Go ahead.
Nursing homes, very good business because once again, you can use those principles regarding taxes and you're employing people, same time housing people as well. So there you go.
Yeah, I know a lot of people that they start like assisted living facilities.
Yep,
with like small rental home. Yeah, so we used to go to a lot of those properties actually and take X-rays.
Yeah, a lot of guys I know that have money here in Florida, that's what they do.
Yeah, it's a big business. Yeah,
there you go.
Especially here in Florida.
No facts. So we have some super chats here, Chris, I believe, if you want to bring them up, if you don't mind. All right, Highlander 2016, $2 says, is it the same tax laws for the U.S. Virgin Islands? Ooh.
That I don't know. I mean, I know it's a Commonwealth. I don't know if there's a tax act with them, to be honest with you, because I haven't dealt with that. So.
I don't hear anyone going there either myself, just Puerto Rico.
No, I never heard anything like as a tax haven.
Yeah.
So, it's different because it's a different treaty with U.S. Virgin Islands.
Yeah, I'm not too sure
with Puerto Rico.
That either. Orlando Beer Sing $5 says, on the topic of moving to Puerto Rico for tax benefits, does that work for the Virgin Islands? Would it be the
kind of the same question? Yeah.
Yeah, we're not sure about that, brother. We got here Desmond Montgomery, $5 says, I stopped being independent for 4 months in 2021. I worked 2 jobs in my own business. Is there a way I can still get a tax return or avoiding paying taxes? So she said she worked 2 jobs in her own business and she's stopped being independent for 4 months in 2021. Can she get a return or avoid paying taxes?
I guess you're gonna have to ask whoever was, if it's your mom or your dad, whoever was taking you on their taxes, if they could not take you for 2021, then you could declare yourself independent, file your own return, and then declare yourself on your own return as an independent. Yeah, you could definitely do that.
Okay.
And then I'm sure, I don't know how much you made, so I mean, it all depends on how much you made. So. On the avoid paying taxes question, that's depends on how much you made.
All right. And we have King Kareem, $5 says, I drive for Uber. Is it better? And I'll definitely make over 50K this year. Should I create an LLC for my Uber? Also, can I deduct my car payments?
That's a really good question with LLCs versus S corps.
Yeah.
You want to knock this one out the park?
That was the last one we talked about. Yeah. So at $50,000, I don't know what your expenses are going to be, but let's say your expenses are 20 and you got a $30,000 profit. And you're going to have to pay self-employment tax if you file it on your personal income tax return of 15.3%. And then you're going to have to pay regular ordinary income tax return tax. So you might want to consider becoming you could still do an LLC, but convert it to be treated as a corporation, and more specifically an S corporation. And then you can avoid some of those self-employment taxes altogether. You don't want to avoid 100% of them. So you want to put something in there where you have to pay the self-employment tax on it, maybe $10,000 of the $30,000 profit, and then bring the $20,000 over and pay ordinary income tax, and that's going to save you a few $1,000s on there. So yeah, definitely it makes sense for you, but you want to make that LLC, turn it into an S corporation.
And they have a finite amount of time to do it, right? If I'm not mistaken.
Yeah, you want to do it within the first. Yeah. So if you file it, you're supposed to do it within so many days after you file and form the corporation, and you get your tax ID number. But as long as you do it with it, because a lot of times I do it and I file those forms along with filing their first income tax return, and then the IRS will, in most cases, will accept it.
Okay. Is it within a year or 2 years? I remember
within
we did
a year.
It for me.
Within a year.
Okay.
Yeah, within the year you want to do it. Yeah.
Yeah, because I remember when I had my joint, it was LLC, and I remember you told me, hey, we got to switch you over to S corp because you're pretty much
you were going to get killed. Yeah.
Because I had my government job too. So for you guys that have a side hustle and you have a W-2 job and you're also trying to get on your entrepreneur grind, forgive me if I'm dumbing it down, but essentially you're taxing yourself twice when you do that LLC versus having a W-2 income, right?
Exactly.
Okay.
Because they always say get LLC, but they don't tell you.
Oh,
tax
there's
things.
another one too. We'll keep doing the super chats, but don't let me forget to talk about the 1099K.
Okay.
Oh.
All right,
did we talk about that earlier? Did I talk about
we mentioned no. Me and him were talking about it before you got here.
Yeah.
But we can definitely talk about it.
That's coming next year.
Okay.
So this year right now it's happening. And we'll talk about this.
We could talk about it now.
Okay, so
let's break it down to 1099K because I don't even know what this is. So
okay, so like for instance, like you get Zelle, you get Cash App, you get Venmo, etc. Okay, so if you have a business and you're getting those forms of payment, those payment providers or processors had to give you a 1099 every year. And the way they did it, the benchmark was if you got paid over 20,000 and you had more than 200 transactions in 1 year. If you had 20,000 and you only had 100 transactions, no 1099K, right? So they had to have both of those requirements, 20,000 and 200 transactions, you get a 1099K.
Okay.
That gets reported to the Internal Revenue Service.
Okay.
They have it in your transcript. So then you have to file that and you have to report that income.
Okay.
Well, you know what they did with the Affordable Care Act? They stuck it in there,
aka Obamacare,
with all this stimulus money.
Oh, that's the Obamacare.
No, the latest one. I misspoke. The one that they just passed
on the Trump administration.
With the stimulus. No, the stimulus package.
Okay.
Okay.
Go ahead.
They snuck it in there. Now, what they're doing is, if you have a business account and you're collecting any type of Zelle or Cash App or Venmo or anything like that, if it's over $600 and it's one transaction, you're going to get a 1099K. So let's say you have a garage sale or something, or you sell a couple of items and you got $1,200. Somebody's like, hey, you got Cash App, and you're going to have to report that because that gets reported to the Internal Revenue Service.
Big
difference.
That's interesting because there's been probably a surge in payments being done through Cash App, Zelle, or these because of the pandemic. Essentially, a lot of people started digital businesses. A lot of people started using these type of payment processors.
We're in the gig economy, so everybody's working from home remotely, and you got your websites over there. That's, a lot of your guests there.
They're selling feet pictures that you chicks are getting caught now.
Literally.
All right. Y'all getting them Cash Apps. PayPal. The IRS is coming, goddammit.
PayPal too.
You know what I'm saying?
PayPal too. PayPal too. Yes.
There's a rumor about if you put an emoji as the description, for some reason it wouldn't register as like a transaction. I don't know if that's
maybe
true
that's a hack. We're gonna have to try that.
I was like, what?
Maybe test it. Test it. Yeah.
Stop typing.
Keep good records.
A description. Just put an emoji. I don't know if that help or not. Hey.
Interesting. I don't know. Who knows? Because they haven't produced them yet, though.
Can
They
you imagine
haven't
somebody's
produced
like,
them yet.
oh yeah, I'm just gonna put emojis on all my shit. I'll be good, bro. I ain't never gonna get in trouble. Next thing you know,
FBI, open up!
you know what I'm saying?
Exactly.
You
That
get-
was hilarious.
Yeah, I
you
don't know
get
about
dragged
that.
away in cuffs and shit.
Where'd you hear that from?
It was some meme going around. I don't know,
Really?
man. Some
Okay,
random thing
yeah.
on social media.
Sounds like shit.
So.
Okay, let's hit some of these chats. And guys, do me a quick favor, man. We didn't want to stop the show for likes. Do me a favor and like the goddamn video because we just gave y'all
Gems.
a whole
Facts.
clinic on depreciation versus cross segregation, aka a more accelerated form of depreciation, and showing you guys the secret sauce. This is how the wealthy stay wealthy, guys. This is how Robert Kiyosaki, Grant Cardone, etc. They basically are able to use depreciation along with accelerated depreciation to bring their earned income to almost goddamn zero. And that's how they don't pay taxes. You know, some of these guys are probably paying less taxes than their own employees that make $50K a year. You know what I'm saying? It's ridiculous. You know, maybe would you fair? I don't know.
Yeah.
Yeah. That's
Oh,
what
yeah.
they're doing.
Yeah.
You know. Okay, $10, Mr. Onizuka, and it's all 100% legal, by the way, guys. It's all 100% legal. I need some help figuring out what my 18-year-old daughter should invest into. She currently has AK and she has put $2,500 into ETH.
ETH. Is that
ETH.
Ethereum?
Yeah, Ethereum. Yeah.
Buy more. It's down. It's low. It's
There
like
you go. It's low right now.
buy the dip.
Yeah.
Put her all underneath right now. Yeah, because that's a safe coin to it's more of a blue chip coin. So I would definitely, without getting into the other alternative stuff.
Yeah.
Yeah. I think you got a lot of.
Yeah, I got a lot of
yeah.
Ethereum. Like
It's down now, but it's
Charlie and
yeah.
Miguel for that tip.
Yeah.
Shout out to
Charlie
them.
Miguel
Yeah.
were telling us, shouts to our crypto guys. I was actually on the phone with Charlie a couple days ago. When in doubt, guys, buy Ethereum. That's literally what they say. When in
Yeah.
doubt, just buy Ethereum. You know what I'm saying? The problem with Bitcoin is that it's a little too high to get into now. I mean, right now it's on a dip. Last time I checked, it was around 35K.
35. Yeah.
Let me see what it's at right now. But
I think ETH was like in 2000 something.
yeah,
It's like in
so
2000.
let's see here at the market right now. So as of this very moment, okay, 9:57 p.m. on Monday, 36,313 is what Bitcoin is at, and Ethereum's at about 2,400.
Yeah,
so-
buy more.
Yeah. So
Maybe
yeah, man, buying a dip, guys. Buying a dip because it's gonna go back up. Manny, any accountant Steve knows personally in NYC or Northern New Jersey he could recommend me to work with?
No, unfortunately.
Okay.
Yeah, I don't have any contacts there.
But you do New York as well, right? Or
I do, yeah, but
because
a
you're
lot
from New York
less now.
originally.
I'm originally from New York. Yeah.
Yeah.
Yeah. So yeah, I don't not too much anymore.
Okay.
Yeah.
Okay.
With $5 from Pause Nation, with a death involved, will there be a tax event upon withdrawal from an inherited IRA BDA transferred from a 401k account with no job or income? Oh shit!
It's very specific.
With a death involved.
Can you highlight it, Chris?
Will there be
If that's involved,
a tax event upon withdrawal from a inherited?
IRA.
Yeah, I could read it one more time. With the death involved, will there be a tax event upon withdrawal from an inherited IRA BDA transferred from a 401k account with no job or income? So what it sounds like to me is you're basically taking money from someone that deceased 401k. Is that a taxable event?
I mean, I don't know what the dollar amount is. I'm assuming it's a substantial. If they give tax it, it could be under what, $16,000, I think it is. But I believe
Need more
if it's coming
details?
from, because the 401k, anytime you have a withdrawal, whoever is the custodian of that account has to fill out specific forms with the IRS and report it.
Yeah.
There's no way around it.
Mhm.
So depending on how they code that, if it's going to be coded as a rollover or a full cash out,
Mhm.
I'm assuming it's probably going to be a taxable event.
Yeah.
Okay.
It probably
Yeah.
will be no matter what.
Yeah. I mean,
It's not like it's your own. 'Cause,
Yeah.
you're
you
not
would need
taking it
more
from-
details too. To
You're not
conclusively know, right?
recharacterizing your own retirement account into another, tax sheltered account.
Yeah.
So it's from someone else. So I'm assuming that it's probably going to be a taxable event. And yeah.
Okay. All right. And Pause Nation, if you have any other facts that you want to throw to it real quick, feel free to do it. Sebastian, $5 because that's a very particular question. $5. What about purchasing rental units and storing Bitcoin miners inside of the units instead of people?
Is that still very profitable?
that's a good
Bitcoin
one.
mining?
I mean, Charlie was saying no.
Yeah, I don't think that is.
It's
as
a,
good as
it's
it
a
used to
dying
be back in
industry.
the day.
Yeah.
That's a good one.
That's pretty funny, though.
Jab Crow host Joe, would you ever have Nomad Capitalists on someday? I don't know who he
Don't
is.
know
We
who
can
it
look him
is.
up. Exploit. How much money? $10. How much money do you need to save up to get a duplex with an FHA loan?
3%, is it? Was it 3%?
3.5%.
3.5.
3.5, right?
Yeah.
Okay.
Fresh actually did it. You want to tell them real quick about how you got give them the cliffs on your joint?
So I got a property 2 years ago. It was 330K. I put 12K down, which is like 3% of the property.
Triplex, guys.
And my first one, working a regular job, $15 an hour, so it's doable. You need to get approved. You need to live in that unit for like at least a year, so you can do it 100%.
Yeah. It's basically a way to get into a property and control it. The only caveat is you got to live in it for a year.
Yeah. And there's also grants, and there's also special programs where you can actually get loans for home improvements on your taxes. So like you can get up to 20 to 40K. You can put in windows, ACs, all that stuff in your units.
Okay.
Without actually having the money.
Oh shit.
Yeah,
Okay.
there's
What's the
that.
name of it? Because since you remember.
There's companies like Y Green. Another one I think is Elance. Basically, you sign up with a company. They go over your taxes. They go over your property, how much it's worth, how much you own it, and then they'll give you a loan for you to improve the property.
Okay. Do you have to make under a certain amount to be able to qualify, or it doesn't matter?
I don't know. Probably because it'd be unfair if you didn't.
Is it related to like an economic development zone? Maybe because it's in a certain area.
I think that's a caveat
and they're
as well.
trying to like gentrify it.
Yeah, because in my area, that's what they're trying to do. Exactly.
Okay. All right. So, and then we got here $10. Baba Tunde. Hey guys, I always watch the Money Mondays. Thanks for what you guys praying for your continued success. Hey, FNF, God bless y'all. Always. Any recommendations for first-time independent filers?
Any recommendations? Well, I think it was those 3 that we covered right in the beginning.
Yes.
Those
the
would
new
be the
Biden
3. If you go
administration.
back, I don't know if you were joining us late, but those would be the 3 major ones that
At the
you
top of the
probably
show,
wanna pay
guys, check
attention
that
to.
out.
So make sure, like, do you qualify for the because probably somebody claimed you prior, so they might have already gotten the payment on your behalf. But if nobody claimed you last year, then you might be entitled to that $1,400 amount. As an independent filer, I don't know if you have dependents or kids or whatever, so then maybe that's not an issue.
And for some of you guys that are wondering, when he's referring to claiming someone, it's like if your parents can claim you as a dependent and then they get a tax break because they support you. So if you're independent for the first time, that means your parents didn't claim you on their taxes, and now you can actually, you can do it yourself versus them claiming you. And you can't.
Correct. Yeah.
Okay. And then we got $5. Larry, I understand there's ways to save money with taxes, but is there anything we can do that we can get for free, like with Section 179?
I mean, Section 179 is you get a full expense deduction instead of like putting it like we did over here on the board where we're allocating things over years, right?
Yeah.
Where you get to expense the full amount.
Yeah.
In year 1.
Okay.
Example, your car that you guys bought that we did the show on.
Oh,
remember I did the show on. We had the real bad connection.
Should we break that down real fast?
Yeah,
because someone else asked about the G-Wagon anyway, so that falls right into.
Well, the
it.
G-Wagon, because it's a heavy car, it's over 6,000 pounds. It's the same thing. You guys, you can do, and it's got to have a legitimate business purpose.
Right.
Okay. And then it's always better if you're going to deduct the whole thing that you have a second vehicle on hand for personal use. Then you can substantiate that you use that car 100% for business.
Okay.
But if you don't substantiate, if you don't have a second car, then obviously you're using a car for personal use. So you don't want to write 100% of it off.
Okay.
You want to take like maybe 75, 80%.
Okay.
Because 20% or 25% you're using that for personal.
Okay. So having another car will allow you
have another one, because they ask you that question, like, do you have another car available? Because you don't.
That's a gem right there, Steve. Right there.
Yeah. A lot of guys, I'm 100% of it's all business. Come on, you go to Publix, you go out, to the gym, you go, you're using a portion of that percentage of that usage you're using for personal. So you got to be reasonable. That's a red flag.
I guess, real quick, can we give a scenario? Maybe let's say you buy $100,000 vehicle, a Range Rover, a G-Wagon, whatever it is, one of these vehicles that qualifies under this provision.
Yeah.
What are they looking for from a numerical standpoint? I don't know if you want to do it on the board or you prefer to just do it.
Well, it's very simple. It's, certain cars qualify for Section 179. They're very specific. A G-Wagon being one of them, because it's heavy. It's a heavy vehicle. It's over 6,000 pounds.
Okay.
So let's say you pay $100,000 for it. You use it for 80% business.
Okay.
You get an $80,000 write-off.
Bam.
Boom.
That first year.
And
you can choose to take it all up front, or should you do it, or can you also take it up over time? Like
you could, yeah. Sometimes I stagger it because sometimes you don't need that huge deduction. It creates too much of a loss, and they might be expecting more income later.
Okay.
That we could use more of that expense later on. So sometimes I don't do that, or I'll forego some of the bonus depreciation.
Okay.
As well. So you could play around with it, because you could be more conservative because you're expecting to make more money
Yep.
in future years, and you're going to need more expense. So
Okay.
you may not want to take it all up front.
There you go. And
Question,
then
you can only buy one car a year with that benefit, right? Or can you buy multiple cars with that benefit?
No, there's no limit on it. Yeah.
So I could buy
There's-
4 Range Rovers.
Yeah. And you can
80,
take
80K each.
Yeah, I've had clients that they have construction businesses. They buy trucks every year for the right at the end of the year. Like, where am I at? And they'll spend all that money and get a huge write-up because they need to replace their equipment on a more frequent basis. And they'll right in December they'll go and make deals. And
I used to wonder why.
I just learned something just now, bro.
Yeah.
Yeah, I used to wonder why all these people like Grant Cardone will buy Rolls Royce
right at the end of
Colonels
the year.
and
Right
buy
at the end of the year.
G-Wagons.
Yeah.
I'm like, you bought 3 back to back. God damn. But
Yeah.
it's
They'll
right
do
off.
right at the end of the year.
So that he can oh wow, and then you can actually choose to take it up front, and then and I think that this is very important that I would just thought about as Steve was saying that. Remember, guys, that when you're getting a loan to try to buy a home or whatever it is, they're going to look at your profit loss statements. They're going to look at how much money you actually netted. So when you do crazy deductions like that, what you're doing is you're basically saying, "Hey, I made less money, guys," and that will hurt you as far as getting a loan. So it's very important to strategize these things.
That's a good point. However, depreciation is called an add back. So whenever the loan officer sits down or the underwriter that's giving you the mortgage on there, they add back depreciation and they don't count that against you as an expense because it's a non-cash. Yeah,
I did not know that.
That's an add back. So that's even a better benefit.
Okay,
That, yeah.
so that's right there, an unintended benefit right there. So you can actually quick scenario. You buy a Range, it's like it's the end of the year. You need to find a way to, offset your taxes. You buy a Range Rover over 6,000 pounds.
Right.
It's $100,000 for easy purposes.
Let's say it puts you in a loss, hypothetically.
Yeah.
But the bank, when they look at it, they add that back.
They add that 80K back that you wrote off.
Yes. So it looks more profitable for lending purposes.
Okay. Yeah. That's good. That's good. Because I know a lot of people are like scared sometimes to write too many things off because it makes their I guess earned income go down, which the banks look like, yo, you didn't make no money this year, bro.
Right.
The hell?
Depreciation is not one that you need to worry about.
Okay. Perfect.
Well,
so I think that's important for the people to know that you cannot write off the most things and then also at the same time get loans easily. It's
because it goes back to the scenario that you talked about, buying a $400,000 property and only putting $100,000 down, right? And you're still taking a big depreciation deduction.
Yeah.
That's non-cash. So it's not, because the bank's more worried about your cash flow for debt service, right? They want 40% debt to income service, right?
Mm-hmm.
So, they want to make sure so that's a non-cash item, right? In that scenario, because you're putting $100,000 down and you're taking, let's say, a $50,000 depreciation deduction
versus
that's non-cash.
Okay.
Right. So that doesn't affect your cash flow. So that's what they're trying to derive more of the cash flow to make sure that you have enough money to pay your debt service.
And can you tell the people real quick, income to debt ratio, break it down for the people, because this is something that
typically I think that the gold standard is like you were finding it was 40%, right? Wasn't it 40% when you were doing your loans? Basically, that your debt service and all your expenses, that you want to make sure that it does not exceed 40% of your total income on a monthly basis in order for you to have the ability to pay that loan back. Otherwise, you get into a risk with that bank, and they're not gonna,
you're considered a high risk borrower.
Yeah.
Okay.
Or raise your interest. They try to get you on that. That's a healthy cash flow.
Okay.
40%.
40-60. And you want to be the lower that 70-30 is better.
40% debt to income ratio.
Okay. So the lower on that other side, guys, the better, the more likely you're going to get approved for loans. So just know that, especially for home loans to get a mortgage. Where we at?
What?
Yo, we can drop a lot of gems, guys. Like the goddamn video, man. Steve's putting on a clinic out here.
And this is free.
The free stuff, man.
For y'all, man. Reginald Deborah, $5 says, what should I use instead of Cash App or Zelle or PayPal? And what's the best payroll company to use for someone in Minnesota?
What should you use besides that? I mean, they've got Venmo, PayPal. I don't know. You guys got any ideas on that one?
I guess just Venmo.
Bitcoin.
What Cash App, Zelle, or payment with the best payout company to use? Oh, okay. Go ahead, Bianca. Yo, can we throw her on real quick? She's on mic.
Go ahead.
Yeah. Okay, go ahead, Bianca.
What would you recommend?
You got son? Out of nowhere.
Yeah, I know. Just really quick. I think that there's a lot of people that are confused when it comes down to Venmo and Cash App. It's only when the account is a business account.
Yes, it's
not
got to be a business,
account.
not personal social
so
security
if people
number.
are sending you money and it's not a business account,
No.
you don't have
Correct.
to do taxes on it.
Correct.
Oh,
That's a good clarification. Yes,
Yes.
because actually I was talking to
Of course, the
someone
girl knows.
at the
Shout out to
restaurant.
Bianca.
Yeah,
She was selling
yeah.
the feet pics. God damn
To
it.
OnlyFans.
Yeah,
Go ahead.
that's a good one. Yeah, very good. Yes, so let's differentiate. If it's a business account, you're accepting. Like in your case, you got a business account that's going in there. Yeah, that's when you got to pay attention to that.
Yeah.
Shout out to Bianca in the
Just
back.
because I do
Good job.
like a lot of business through there,
Yeah.
and I don't have to pay taxes because I'm not a business. I'm still my personal account.
Correct.
Okay.
Yeah.
But is there a certain amount though, Steve, where like if you're making a certain amount, they're like, bro, it don't matter if it's personal, you got to report this now.
No, I don't think they're going to go and just, put the burden of doing that on all of the personal taxpayers,
Okay.
personal social security numbers. That's a big burden for them.
Yeah.
Just
it
even on the
is.
businesses alone.
You're
It's a huge
chasing after
burden, yeah.
quarters when you should be going after dollars,
Yeah.
essentially, right?
And it's the same thing for businesses too. Like if you pay an independent contractor, anybody working for you here over $600, you have to give them a 1099 by law.
Mm.
So it's kind of the same thing.
Okay.
Even though you're paying them, because you as the business
Uh-huh.
owner want to substantiate that you paid them and you want to take that deduction.
Yeah.
On your
Okay.
return. Yeah.
Fair enough. Maximum Duke, if you comment or flag the payment on Zelle, etc., as a birthday gift, will it still get reported?
I mean,
Again, it's just going to be, if it's a business account, it doesn't matter. If it's over $600 starting this year, they're gonna
Crack down.
you're
on
gonna
it.
get a 1099K.
Yeah. What I've noticed is, as the COVID restrictions have been going down, they've been far more aggressive with pursuing you now for tax
Well, because they gave
reasons.
all that money out and now
Yeah.
they want some of it
They want
back.
to get it back.
And they're gonna,
It's time to recoup.
it's a way for them to
yeah.
keep people honest
They're-
now, and with compliance by force. You know what I mean?
They're getting it back in blood.
So they're getting it
They
back.
gave it to you. Now they're getting
Yeah.
it back in blood. Okay, let's see here. We got $10 Maze Jackson for business owners who can't afford an accountant. How do you recommend we keep our books, receipts, spreadsheet, app, etc.? My other super chat about business bank accounts didn't get read.
Basically, if you're using a bank account, all of that stuff, like we talked about, is all downloadable into an Excel spreadsheet, and you can sort it.
Okay.
Yeah.
$10 Chris Loya. You can send a Zelle payment, Zelle, PayPal, or Cash App. You put in the memo, happy birthday or split check. It cannot be taxed. Don't know how true it is, but something I heard.
Yeah, I heard about that and then emojis. I'm like, I don't know about that, bro, but hey.
What's your take on that, Steve?
Wait, which one are you reading right now? The
Chris
date-
Lawyer.
the-
10.
Oh, the one down. Okay. It says, can you send PayPal, Cash App, and happy birthday or split check to be travel? Don't know. I don't know.
That's a unique situation.
I wouldn't advise to do that.
They're gonna say happy
unless it's
birthday.
legitimate.
Split check.
Yeah.
Wait, how many birthdays people do you know? I actually know. Like they gonna know, bro. Like
Yeah. To me, I look at it like
It's not
you do
worth
that too
it, yeah.
often.
It's not worth it.
You gotta get
what are you
audited,
saying?
bro.
Yeah.
birthday check. Birthday check.
Yeah, they're gonna be
Yeah.
like, oh, okay,
Wait a minute.
it's a birthday every day, bro. The government's gonna be like, listen, bro,
Happy birthday
Yeah.
to ya.
like we ain't stupid. They're gonna be like, you think we're
Stupid.
next thing you know,
Keep my money.
a year later,
Yeah. Chances are you're not going to get caught doing that. But let's say you're the one in a million that does, and then for
Fucking
saving
blows.
$1,000 and then 3 years later, now that bill turns into $4,000. Like, was
Yeah.
it worth it?
Now,
to
if
get
you haven't
audited.
learned by now, look what's
Wasn't
this
worth
next.
it,
Pay
yeah.
your taxes, nigga.
Yeah, pay your taxes, bro.
All
I day trade stocks, so all positions closed. My account was up 500% in 2021. Is there any way of reducing capital gains tax? Oh,
You could put it in a retirement account. That's looking like a self-directed 401k, which we were going to talk about. We'll have to do a show on that because that's something that you guys might want to consider because
okay.
you could stack a
Yeah.
lot of money away for retirement.
Okay.
And he talked about real estate where you could do like a 401k and like a self-directed and
Yeah.
have a piece of property in there as well. So that's something that we could talk about. Yeah.
Okay.
I'm down.
And then two more here. Mr. Zapata, I have 2 different companies and looking to open a third. How should I set up a holding company to move the money without triggering a taxable event?
Fresh. I sent you 2 questions, by the way.
So with those holding companies, you got to be careful because you would be like if you are 100% owner of all 3, then you got to do a consolidated return. It's not going to really help you. You're just causing a more complex tax situation and burden to really save nothing at the end because you got to put it all on one return. Because they ask you if you're more than 80% owner of this one and so forth. So that goes to percentages, and it's a very complex structure that some people do, but there's a certain way to do it, and it's outside of the scope of this discussion here. But that's going to be something where you have to do a consolidated return, and everything all comes together back on one consolidated.
And that's when you got to figure out,
There's
is the
really
juice worth
no-
the squeeze? Are you really going
Yeah.
to save that much doing something like that?
I mean, if you're into like multi-million-dollar and you could sit down and do a proper structure like that, then it might make sense. But yeah,
For most, it won't.
yeah.
Okay. $5. You got to get No Bad Capitalists on your show. That was a great suggestion. Okay.
All right.
And then Kendall Short, $5 super sticker.
We
Thank
got
you so
two
much.
here. We got D Miles.
Mhm.
Is the unemployment the same as medical leave?
No,
I think we answered that one already.
no.
No. And then Mal MC $20 says, if I have a for-profit company, can I use section 179 of the IRS tax code to get a G-Wagon? No, we did that.
Yeah, we talked
Yeah,
about that. Yeah,
okay.
definitely you can.
So real quick with the medical thing, what's the difference between the medical? What was that question again? Medical.
So
That's a good question.
Medical leave versus unemployment, is it the same?
So medical leave is more of a benefit from your employer,
Okay.
where unemployment comes from the state.
Okay.
Yeah.
So they're not the same as because we talked about unemployment this year. If you make over $10,200, you got to pay taxes on that.
Right.
Not the same with medical leave where you don't pay any
That's
tax
a
on
benefit
that.
from.
That's a benefit.
Yeah, it's from.
Okay.
This is a very high IQ conversation.
Yeah, no, it definitely want to make sure everyone gets the value. And then what's the last one here, Chris? And then we got $5. Kendall Short, NMLS 2171127. You can use rental income to offset PITI. Conventional, try to stay under 41%. Okay, what the hell? Can you translate that to English for us, Steve?
And MLS, is that the multiple listing?
Yeah, no, it's
MLS is like the multiple
listing
listings.
number. Yeah, that's listing number. So
Yeah.
okay.
Oh, so maybe he's trying to give you some type of listing somewhere, and I don't know. I'm lost.
That's a code for each listing.
Yeah, for each house. Yeah, and
So
yeah.
I don't know what you're trying to say there, bro.
I'm confused. But
All right, brother.
I'm
Until
so
next time.
confused. Well, maybe that's a good real estate property. I will look it up in the MLS. Anything else, Chris?
Last question.
Last question?
Don't want to send questions yet.
Okay, Marco, do I need to buy real estate by the end of the year to take advantage of the tax benefits for that year?
Say that again.
He's asking,
Should I buy real estate?
do I have to buy real estate by the end of the year to take advantage of tax benefits for that year? I mean, I can answer real quick and then I'll turn it to Steve.
Absolutely. Yeah, it's got to fall within the calendar year.
Yeah.
Tax
So scenario I gave you guys earlier, I found it. Basically, long story short, it was mid-November. I couldn't get a loan in time to do a real estate deal and close by the 31st before the end of the tax year. So what I did was I went and found a house that I had money for cash. I purchased a home cash so that I can close the deal, and I actually ended up closing the deal December 30th, guys. And the only reason I did that deal, to be honest, even though it was a single-family home, not typically what I buy, but I purchased it because I knew it was going to be an excellent tax write-off because I knew it had just been rehabbed and it would bring me some cash flow around $2,300 per month. So. But the main reason I bought it was to offset my taxes. So I purchased it cash, and that house was able to significantly reduce my taxes with the depreciation that we explained to you guys before with the 27.5, as well as the accelerated cost cost segregation. So you have to buy it in that calendar year to enjoy the benefits from tax, the tax break.
Yeah.
So,
Steve, where can I find you?
You can find me on Instagram, Seeing Beyond the Numbers. And
You won't respond. Awesome.
well, tell them because
maybe not this time of year because I'm like extremely busy. But I'm not taking on new
client list.
Yeah, we're not taking on any new clients unless it's it's on a case by case basis. So obviously, like good client referrals, typically it's over $500,000 or more per year, or if they have a business that's been they've been around for like 5 years. And they're like, maybe 1 million gross or something like that. Yeah.
So basically, it's just a polite way of saying he ain't dealing with you broke guys. Okay, you got to be high net worth for it to contact them because they're busy as hell, which is a good problem, man. It's great that you're in business and obviously you're doing a lot of things.
Yeah, I'm blessed.
I mean,
I'm blessed. I'm not going to complain.
Puerto Rico.
And real quick, I just want to tell you guys want to know how I was able to buy that house cash? It's thanks to you, Steve. We did an SBA loan.
Yeah.
I got an SBA loan for about $124,000.
Yep.
Right. I took that money, right, saved it, put it with some of my other earned income. And we were able to purchase that house cash. And that SBA loan, guys, that I got, it's I have 18 months to pay it back, and it's at a 3.5% interest rate over 30 years. So it's basically another mortgage.
And you can defer it up to 18 months.
Yes,
18 months.
It's deferred for 18 months, so I don't have to pay.
I mean, it accrues
interest,
but
So here's the beauty. So let's do the math. Bought the house for $265K cash, right? It generates $2,300 a month. I used the loan to get it, right? I used the loan to fund half of the deal. Now the house generates $2,300 per month, but now I'm collecting that $2,300 full because I don't have a mortgage on it.
Right.
However, I got to start paying back the loan after 18 months. But I did the math. Each payment is only going to be about $624.
Right.
So you go ahead and you go
$1,700.
$1,700, approximately $1,700 bucks I'm netting in 18 months from now. You know what I'm saying? So basically, I was able to use other people's money, procure an asset that pays me a dividend, and I'm still netting $1,700 positive after I'm going to start paying. So guys, these are little things that you can do that will help you. That's why the importance of using other people's money, guys.
The loan closing process on that was how easy.
So easy. And the thing is, this loan isn't available anymore, guys. Sorry.
Yeah, that ended last year. Yeah,
you know what I'm saying?
31st. Yeah, unfortunately.
But had it not been for Steve bringing it to my attention, I would have never done it and not had that extra capital to be able to deploy to purchase that property.
Right.
You know what I'm saying? Especially with, the time crunch that we had, because getting a loan, guys, takes a while. It takes, they say, 30 days to close, but realistically, sometimes it takes, 45 to 60 days even sometimes to get the loan, all the way approved. Because nowadays getting a loan is pretty tough with COVID, man. You got to put 25% down. They want to basically know your dick size, how much money you make, how much your grandma makes. They ask all these really invasive questions. So with that loan, it wasn't as intrusive. I was able to get it fairly quickly. It was easy. 3.5% interest rate on $124,000. That's chump change if you put it into an asset, make money back, pay back the loan, but it doesn't matter because you're profiting like crazy.
Yeah, I think you did it online.
Yep.
You provided a couple of documents.
Yep.
Got a call from somebody to answer some questions, and within 48 hours, you had your money in your bank account.
Yep.
Directly deposited.
Yep. Good credit. They gave it to me.
The closing cost was what, $500?
Something like that.
$500
yeah.
for the closing
completely
cost.
legal, guys. Yeah. It was a relief loan for small businesses, which obviously, I have my LLC, everything like that. I met the prerequisites. We filed it properly, right? Don't do any of this stupid shit with fraud, guys. Don't follow these PPP loans. It was not because you actually have to pay this one back. The PPP loan, guys, you don't have to pay back. It was a grant.
Right.
And that's where everybody's getting hit with the feds and getting arrested because they were just basically taking that money, buying Lambos and shit, doing stupid stuff.
Right.
But this one, you actually have to pay back.
Shout out to all the scammers.
Yeah, shout out to all you scammers out there. But
all right, guys.
Cool. Hit up Steve on Instagram. Girls. Check him out, guys. If you're high net worth individual, this is who you want. This is the guy that does my taxes. He saved me a lot of money this year. So other than that, guys, we got some ladies here.
You should save me more money. That is good.
Yeah, we got to work on your stuff.
Yeah, we do.
All right, let's go. Let's go get to work.
All right, guys. Peace.
Peace.